The event is live.
Good morning, good afternoon, good evening, wherever you are dialing in from. Thank you very much for joining us to talk about sustainable finance impact where it matters most. I am joined by an incredibly distinguished panel to talk about Standard Chartered's role in this space, and I will come to the attendees in a minute. But just to introduce myself, my name is Daniel Hanna. I'm the Global Head of Sustainable Finance at Standard Chartered. I think sustainable finance has been one of the pieces of good news in otherwise a challenging year. The record-breaking momentum that we've seen in the growth in this space has been much appreciated, but building back better is going to require much more than this. It's going to require the finance sector to recognize that impact matters just as much as volume. Where is as important as how much. As we're going to talk about later, a dollar invested can have a significantly different outcome depending on where and how it is deployed. And we also believe that in order to finance the change that we need to see as a planet, we need to switch the focus from green bond league tables to how do we catalyze, standardize, and democratize sustainable finance. The reality is we need to mobilize much more sustainable finance and catalyze the efforts of everyone in this space. Standard Chartered, individual banks, individual investors can't do this alone. The new financing required to keep global warming to an increase of just 1.5 degrees may be as high as $3.8 trillion a year, while the UN estimates that the funding gap to reach the SDGs is $2.5 trillion in its own right as well. One of the biggest obstacles to raising more sustainable finance, frankly, though, is the finance sector itself. We don't make this very easy for investors out there. There is an alphabet soup of different standards, acronyms, impact reports, and the like. And when we've talked to investors, one of the biggest bits of feedback we get is the lack of information and transparency on impact, one of the things that really holds people back. And so that's one of the things that we're going to talk to today, is about how Standard Chartered is trying to provide that transparency to those that come alongside with us in terms of sustainable finance. And then finally, we need to democratize the benefits of sustainable finance. As we're about to talk about, funding is not flowing to the countries that are at the greatest risk of climate change, but that we believe have the greatest opportunity to leapfrog to low carbon technology. So with that, maybe let me start by switching to the panel and in the first place introduce Tracey McDermott, who is a member of Standard Chartered's management team and has overall responsibility for our sustainability strategy. Tracey, coming to you, maybe what are your initial thoughts about this space?
Thank you, Daniel, and good morning, good afternoon, good evening to everybody, and thank you for joining us today. I'm very excited to be able to be here to be part of the presentation of this first Sustainable Finance Impact Report that we've done. As I suspect everybody on this call is well aware, the UN Sustainable Development Goals back in 2015 set out a blueprint for what they described as a future peaceful and prosperous world, with an aim of achieving those goals by 2030. There has been some progress in relation to that, but there's also been setbacks. And this year, the impact of COVID is estimated to have wiped off a lot of the progress that's been made and runs the risk of putting many people back into poverty. So just 10 years left to meet the Sustainable Development Goals, and we know there are huge gaps to fill. Daniel touched on this in his opening, but current estimates are that just 60% of the required financing that's needed in low and middle income countries is actually available. And in Africa, that number is as low as 10% of what's needed to fund the SDGs is being made available. Earlier this year, we published a report called Opportunity 2030, which identified the gap in relation to funding for the SDGs and also the opportunity that provides for investors, for banks, finance institutions to really mobilize that finance and to do good and also to make a profit as a result. But we do know that the investment is still not flowing into where it matters most. And that's really where we see that Standard Chartered and you come into this. You know, we operate in many of the markets that are most at risk of not meeting the Sustainable Development Goals. Climate change is the one that people talk about the most, and our markets are at risk there both from the physical and transition impacts of climate change. But there's also issues around infrastructure, around education, around reliable power. Investors say they want to invest in those markets, that they want to see the impact. They want their dollars to be used where it can really make the most difference. But actually those markets are sometimes difficult to navigate. Their standards are not necessarily as transparent as you might see in Western markets and so on. So we believe that there is a real role for Standard Chartered to be able to connect that capital, to connect investors who want to have that impact with those markets where the most impact can happen. And we do have a long history of innovation in the sustainability area. We set up our own environmental and social risk management teams back in 1997. We started reporting on impacts, not sustainable finance specifically, but the impacts that we have back in 2006. And we obviously set up the sustainable finance team that Daniel now runs in 2018. And our aim is that through creating sustainable products, we can enable people to invest in a way where they can be confident about the standards that are being applied, they can be confident about the rigor that's been disciplined, and actually but still touch those markets where it really matters. So we set up our green and sustainable product framework. We've got external verification of that. We verify the assets that sit behind our sustainable bond and the sustainable deposits, so that we're trying to make it easy for investors to have confidence to invest. And by publishing things like our impact report, really demonstrating how those dollars are turning into genuine impact on the ground in real life. 91% of the assets that we have verified as sustainable and that are backing these things are based in emerging markets, and 86% of those are in the world's least developed markets. So we really think that there is an opportunity here to catalyse that desire to drive impact in the places it's needed in a way which is safe and sound. And that's what this report gives you a snapshot of how we've done that this year. And this is just the start. We look forward to continue to grow this business going forward. Daniel.
Great. No, thanks, Tracey. I think that was a fantastic way to set the scene for this conversation. I think just talking to everyone in the audience now, I mean, I think we very much want to hear from you as well. So please put in some questions. And we're going to try and create as much time to tackle those questions at the end of the sort of introductory set of remarks. Richard, if I can turn to you now, as our head of capital issuance and term funding, could you maybe talk a little bit around how sustainable finance and our targets and the aspirations that Tracey sort of set out are being woven into our issuance plan, and maybe also just how unique Standard Chartered is, you feel, in terms of these sort of issuances for investors?
Sure. Thank you, Daniel, and good morning, good afternoon, good evening, everyone on the line. So I think, as Daniel mentioned, we're a team, in terms of capital markets execution from our holding company, we're a team that has about $10 billion a year that we need to deliver. So that gives us a reasonable opportunity to pick and choose the appropriate transactions we want to kind of align with our sustainable bond framework. As we saw last year, we obviously announced the framework, put the bond framework in place, and very quickly after that moved into kind of execution mode against that framework. I think one thing that is really important is we've consciously not done another issuance since then. And that was a very conscious choice. We wanted to make sure that our framework was understood, our impact reporting was understood, and that we could then have a dialogue with investors about how the funding plans we have, the assets we have, and the kind of how those interests really marry up and drive that kind of conversation forwards. I think one of the key things we did on our own transaction was, as I think Tracey alluded to as well, we have this third-party opinion provider. We did a pre-issuance verification. I think that was relatively rare in the market at the time, to really give additional transparency, additional encouragement to the investor base that the bond we were bringing to market really is targeted and within the framework that we've laid out. And I think that's incredibly important that we have these assets, as Tracey alluded, in some of these most needed and underdeveloped parts of the world from a sustainable finance point of view. We have the assets on our balance sheet. We have the pipeline of those assets that we want to kind of introduce effectively to investors. And our framework and indeed our impact report is a very good way of doing that. I think as we kind of look back at the transaction that we did, we did a 7-year tenor, so an eight-year with a call after 7. I think that was a reasonably long tenor commitment to the sustainable space. I think that is a demonstration of the assets we have, the faith in the assets that we have on the balance sheet, and the faith in our pipelines. And I think that we're looking forward to doing more of those kind of tenors. We're a dollar-funded bank. There's no question about that. But we did this transaction in euros. The euro investor base to date has probably been the most sophisticated and most advanced in their diligence of sustainable assets. And I think it works very well for us to marry that investor base appetite with the issuance we did. Over time, I think it would be nice to see more US dollar issuance in this space. And that neatly marries up with the assets and the funding plans that we have. I think lastly, I'd say that as an organization, we're probably very encouraged by how the sustainable bond market in general is growing. I think as mentioned, very few of that funding or liabilities that are raised are targeted in to emerging markets. There's a lot of European, a lot of onshore China, but very few are targeted at the assets that we have. And I think that gives us a unique opportunity to engage with investors, to partner up, as mentioned. And I think our the impact report that we just announced really provides a good level of transparency to that conversation. And I think lastly, it's not all about bonds for us. Tracey mentioned it as well. We have a sustainable deposits program. It's I believe it was one of the first in the world to kind of be rolled out. And now we probably have over $2 billion of sustainable deposits being targeted to our kind of core client base. And it's interesting, we've got an evergreen version, an Islamic version, and even a wealth offering. So we really are developing alternative methods of offering the assets we have, and marrying that up with a broader liability structure. It's not just bonds. We want to issue more medium-term funding, but I think it's important to note that we do have different avenues to kind of bring investors these opportunities.
Great. No, thanks, Richard. And again, in the audience, if you've got any questions that you want to pose to the panel, please do put them in, and we'll pick them up after the introductory remarks. Henrik, if I can turn to you now. Henrik Raber, the Global Head of Credit Markets for Standard Chartered. Henrik, you recently concluded a very successful and very well-attended ESG Sustainable Finance Conference for financial markets, and obviously your team have been instrumental in the growth of green and sustainable bonds. What's your perspective on this situation at the moment?
Thank you, Daniel. This space has been really evolving very rapidly and continues to increase in terms of velocity, and not only with our clients, our investors, but also our employees. This is a groundswell movement around the ESG space and covers a lot of topics. I think the transaction we did in 2019 was a first step. It's one that's going to be followed by many more. For us, it also gave our investors a relatively unique proposition. You were buying an issuance from a UK bank that gave you exposure to 1.3 million through microfinance, which is a really unique opportunity. I think the ESG space is really going to continue to grow at some pace. If we look at the primary markets, both bonds and loans, they tend to be the ones which are most often referenced, and they're also maybe the easiest ones to track. So bond issuance, for example, which has been propelled by COVID, and COVID financing is also an important part of ESG. They've risen from 300 billion to 425 billion this year. So very material growth. But also the loan space has grown very significant. So primary loans in 2017 used to be 47 billion, and then with this year will probably exceed 200 billion. So very significant growth. And that is indeed driven by investor demand. We see that in a range of places, whether it be primary or secondary. But we also see how the order books are changing. So all investors are increasingly asking about ESG. This is no longer just a dedicated space. Real money funds in their general funds are asking our issuers and ourselves about our ESG credentials and how we're doing that. Clearly in the ESG space, proceeds, tracking of proceeds are a very important topic. And it is, as you outlined in your opening, still a slightly alphabet soup situation with different rating agencies, different approaches, etc. But increasingly it's very, very attractive. I think we will all seen some of the performances this year of the equity ETFs that are tracking, for example, solar or clean. They've vastly outperformed some of the other industries or sectors. So it is an opportunity. I think in addition to the deposits, green finance space, we're seeing the derivative space also lob quite quickly. There have been transactions in the FX markets linked to ESG KPIs. We're increasingly seeing green swaps. And I think next year you'll see a wide range of financial products evolve in this space. It is hugely supported, and I think it's going to continue to grow in opportunity. And through that, one of the important mechanisms, which I'm sure you'll talk about, that we work on with our clients, is transition mechanisms, especially given emerging markets. An emerging market space is a combination of financing, but also countries are still building basic infrastructure, and the same for many of our companies. So that transition framework is super important. We'd love to hear questions from the audience around this. We're very excited. The conference where we did a few months ago, we had over 6,000 register for 12 sessions. We had 70 external speakers. And what was really encouraging was the follow-on that we had from that. So not only the initial take-up, but those dialogues have sparked a range of conversations. And I think the interest is also moving away from the historical green space and is becoming a lot more nuanced. So there's a huge interest, and I'd probably say where we have the most requests today is about blue financing. So assisting the oceans, assisting coastlines is a really exciting area. Vaccinations, the financing of new vaccinations in the ESG, and especially post-COVID, has been an area where we've seen a lot of interest, where both development organizations, public and private investors want to support. So I'll leave it there and hand it back to you, Daniel.
Thanks, Henrik. No, I think that's fantastic, and you've touched on a number, I think, of really important themes there. And it's great to see we've got some questions already, which I'll sort of pick up and maybe direct initially at one of the panelists, and then, but by all means, please, as the other panelists think there's anything to add, just jump in. So maybe to start with you, Tracey, on Chris McHugh's question, which I think is a really good one, which is how well do you, I think it says, how well do you distinguish, if you like, the different attributes between green and sustainable bonds and align to your own balance sheet strategy? I think if I may broaden that question a little bit, I think one of the things that a lot of investors are concerned about is kind of like, oh, it's great you've issued this green bond, but does it really align to your strategy? How much is you driving this at the very top of the organization? How much is the organization as a whole coming together to focus on these things? So maybe would you just share a little bit about the tone from the top and kind of how this picks up? And then Henrik and Richard, maybe if there's anything you want to add to that after that.
So, thank you. So if I start with tone from the top, and then I will come to the sort of overall strategy. I mean, I think it's fair to say that at the moment, not all of our balance sheet is completely aligned to sustainable and green certified assets, but we do see that as a key part of the way forward. We've committed in our own sustainability aspirations that over the next 5 years we will fund and facilitate 75 billion towards renewable energy and sustainable infrastructure. So that's an indication of the size of the commitment, and we've made that commitment publicly and we report on that publicly. As Daniel said, the actual absolute number doesn't necessarily matter. What matters most is the fact that that 75 billion is going to hit the ground as set out in the examples in the impact report, with things like solar arrays in Bangladesh, with things like, building hospitals in Zambia and so on. We've also been very focused on the question of how do we measure and manage our emissions and ultimately reduce those. And, as well as the emissions which we directly control, we've really been focused on how do we measure the impact of our financed emissions. And that's a really complicated question which a lot of financial institutions are grappling with and which regulators are increasingly focused on. But we're very much looking at that because we think that the more transparent we can be about that, and the more we can then see how we're supporting our clients through a transition, so that we don't cut off development in the markets that are emerging and need it, but that we help those markets to transition to a more sustainable future. And we do think there's a key role for us to play there, because one of the risks of the alphabet soup that various people have referred to is actually we run the risk that Western companies that are based in Europe or in the US, will find it much easier to provide the sort of data and metrics that will give investors comfort that they are sustainable, and we will inadvertently cut off the flow of financing to the places where it matters most. So that's been a big focus for us. As I mentioned, we're quite focused on transition and how do we help our markets to become more sustainable. We have, however, taken some active steps. So we stopped funding coal-fired power plants a couple of years ago because we took the view that actually there was now sufficient alternatives available that we should be making that stand and really focusing on how do we build out renewables. We've made a net zero commitment in terms of our own operations to meet that by 2030. Our CEO, Bill Winters, recently was the co-chair of the task force on scaling voluntary carbon markets, which is going to be a really important part of enabling people to meet these net zero targets. Our chairman is part of the Global Alliance for Sustainable Investment. So we've got a lot of commitment at the very top of the house. But actually, it doesn't just stop there. And I think Henrik made this point. This is something which goes deep through the heart of the organization, and our people really see this. And just to sort of make a final point in terms of putting our money where our mouth is, so to speak, in the course of this year we established a $1 billion pot available to fund companies that were providing services relating to COVID, so people moving manufacturing into PPE or helping to distribute relief, and we provided that at cost to clients, existing clients, to make sure that we could mobilize money the way people needed it. That was in addition to a $50 million charitable fund which we established, 25 million of which we have dispersed in terms of immediate relief, and 25 million of which will go towards recovery. So this commitment to doing the right thing and to driving those sustainable goals is really a key part of our ethos as an organization. And as I said, to go back to Chris's specific question, we will be growing this part of our balance sheet as we work with clients to help them transition. We will see the sustainable assets increase over time.
Great, thank you, Tracey. And I don't know, Henrik or Richard, if you want to add, but I do think one of the things that is so important around this whole space is that the changing in technology means that you can effectively be sustainable and support growth. So, for example, I know in the impact report we talked about one of the transactions that we financed was the import of solar equipment in rural Bangladesh. Where not only will that help provide clean energy, but 130,000 people are going to probably will be positively impacted in terms of better access to power and also creating a number of jobs. But Henry, Richard, anything you want to add on this very important point?
I was actually going to raise potentially a question for you, Daniel, because I think when it comes up to, in particular, green sustainable bonds, and we have a lot of questions coming in on the chat channel, is greenwashing. So I thought maybe I'd tackle that one up front. And I know that, Daniel, you spent a lot of time on this, both in terms of investors and in some of the forums that are discussing this. Could we maybe have some of your comments on the greenwashing and where we stand as we close out 2020 looking into a new year?
I don't know if the panelists are allowed to ask the moderator questions, particularly hard ones, Henrik. But no, I think it's a really, really important point. And actually, I want to come to Tracey as well, because I think amongst the number of roles that Tracey does for the bank as being part of the group management committee is responsibility for compliance overall. But I think this is a key point. I think in terms of what we've seen so far is this plethora of issuances and the record-breaking momentum, which I think is really encouraging. But one of the concerns that I think we do hear from investors is this issue around, okay, are you really having impact, or is this just greenwashing? And it's something that we take incredibly seriously. Part of the reason that we have such a clear impact report is to be able to give investors, both into the bond and our sustainable deposits, very absolute clarity in terms of the impact that they're having on the ground, whether that's in terms of the jobs created or the amount of CO2 that effectively we've been able to avoid as a result of their financing. So as the report says, 750,000 tons of CO2 just in the last year, for example. And what we've done within the bank is make sure that there's a really robust governance structure to effectively, it's not just me saying that, but there's a number of checks and balances. And you'll see that in the last investor relations report that the bank put out when we did our results. It includes that governance structure. So we have a sustainable finance governance committee that is effectively a majority of kind of second line risk, legal, compliance people who, when we say something is green and sustainable, it has to go through that committee and to be verified that actually, yes, it is having additional green and sustainable impact, and that we're comfortable that there are a number of controls around it. The other thing particularly you'll see both in terms of the framework that we've put out that sets out exactly the link between the financing that we're doing, the sustainable development goals that that's supporting, and now as well we've updated that to point to where it overlaps with the EU Sustainable Finance Taxonomy, is that overall framework was verified by a second party, Sustainalytics, and they've been actively involved in the impact report and the bond issuance as well. So again, we've had a second party, which Richard talked a little bit about, giving that sort of overall assurance. This, I think, is going to be a really key trend. If we want the market to continue to grow, if we want to direct the amount of capital that needs to be directed, we have to be able to give investors the confidence that the money that they're putting to work is having the desired impact. So I think it's a really, really important question. But Tracey, I don't know if you want to add anything to what I've just said.
I think you've pretty much covered it. The one thing I would just add, though, is that, from our perspective, we see this as part of, just as an important part of transparency and clear and fair information to our customers as on any other product feature. So that the sort of core of the committee that Daniel talked about is about making sure that what we are putting out there is absolutely true. And there's a question that's for Richard in the chat around sustainable deposits and around institutional investors and retail wealth, and I'll let Richard answer that. But interestingly, one of the big debates we had internally was because when we first had some retail deposits, massive demand from that for retail, actually, real interest. And we had to sort of slightly put the brakes on how much of that we did, because we needed to make sure that we had the verified assets that we could sit behind and we could say, actually, yes, we know that there is something we're matching against that. So we do take this very, very seriously and take it as a kind of key sort of conduct and trust issue, really not just a technical one. But I don't know whether Richard might want to pick up the sustainable deposits question as well in response to that.
Sure. Thanks, Tracey. And just following on to that point, I mean, obviously, when we did our first bond issuance before we come to deposits, we had a big discussion internally about what was the appropriate size. What was the appropriate size of that issuance? That issuance was 7-8 times oversubscribed. We could have done a much larger transaction, but it was all about making sure we had the appropriate diligence assets on the balance sheet, while also giving ourselves runway to develop more products and to become more democratic in terms of where we were offering financing to. And I think that deposit product is really a very nice way of democratizing investor appetite, because it's not just the largest asset managers in the world that want access to this wealth product. As mentioned, the deposits we have, I think it's kind of a mix of corporate clients wanting access. You do have FIs, and I think the wealth side is probably beating down the door as much as anyone else, trying to get more access to our green and sustainable assets, but we're trying to make sure that we are as, I guess, fair is maybe the wrong word, but as diverse as we can from offering the relatively bespoke pool and unique pool of assets we have to our client and investor base. So it's a very diverse pool of depositors at the moment, as I said, but we're looking to grow that, roll out as and when the opportunities arise. But again, we do want to make sure we keep enough powder in reserve for big ticket bond market transactions as well. So as I said, it's a bespoke Standard Chartered offering, and I think that is what people want to buy into. They know the diversity we have. Not many people can offer that level of that level of depth and breadth to the overall asset base that we can. So we do have a lot of people coming in and looking for access to our assets.
Great. No, thank you, Richard. Henrik, there's been a number of questions around transition, and I think your comments earlier around vaccine bonds and blue bonds caught some attention. I mean, do you want to just talk a little bit about how the sort of sustainability market is evolving and where you see sort of the future growth opportunities in some of these themes, and maybe also some of the challenges?
Thank you. Obviously, it's been evolving very quickly. As I mentioned before, the actual underlying growth in the issuance has evolved. I think a second part that's involved has also been the pricing. So just touch upon that, is that we've increasingly seen ESG transactions priced tighter than where an issuer would raise conventional funds. And to Richard's point, the oversubscription of some of these transactions is very significant. Thereby, the pricing is also coming in. So issuers who are issuing transactions are finding a pricing benefit in addition to the other benefits from doing sustainable finance. I think then we've seen the products and sort of the sectors expand quite rapidly as investors are looking to get specific exposures rather than maybe broad-based exposures. So blue, as I touched upon, there's been a handful of transactions, and we expect that to grow. It's obviously not been as fast as some of the other green-linked transactions, partly because also financials are large issuers of green bonds. And given their large funders in the wholesale market, that does skew the financing. But the blue space is really to help protect reefs or help support fishing communities. And I think that's one of the sectors where we get the most interest from. Particularly in emerging markets, we need to clearly be very diligent on the use of proceeds for some of these transactions. To touch upon the vaccination side, various multi-development banks, particularly in the West, have historically done transactions to help with vaccinations. So they've used their strong credit rating to raise funding at very attractive prices and then help support vaccination programs or develop vaccines. Now, that has been a more niche market, but on the back of the COVID, obviously this has expanded very rapidly. So most multinational banks this year have now issued very significant financings to support COVID initiatives, or predominantly maybe to help SMEs or specific sectors, or like the fund that we did to particularly help PPP or other things. But looking forward, using bond markets or loan markets and harnessing large pools of capital to develop vaccines, I think is something that's really going to start taking off. Historically developed by large sort of corporates. Now, obviously, many of them having great ratings and funding attractively as well. But I think this is now becoming much more of a world issue or pan-country issues, regional issues. So I think you will start seeing that up. We would love to hear more from investors around developing specific products. We do hear from large, for example, family offices looking for specific investment opportunities. That's an area that's growing very rapidly. And that can be by region, so trying to help Africa, for example, microfinance. We've also had a lot of inquiry helping youth unemployment, youth education. So there's a whole range of things. And I think that's one of the most exciting parts of ESG is as we see the breadth grow, the number of opportunities and number of products or a number of specific ways to help society is really expanding.
Thanks, Henrik. Tracey, there's been a couple of questions around transition, and also I think the data that around our own financed emissions, and then social risk. So if I may, I'm going to come to you in a minute just to have answered some of those questions, but maybe just building a little bit on Henrik beforehand. I mean, I sort of very simply, I think if you think back to those numbers that we need to catalyze, we need to see, I think as Henrik very well put out, a lot more innovation. And at one level, I think we basically need the success of green to become 1,000 shades of green. So we need green to become olive, because this issue around how do you finance brown companies become less brown, I think is absolutely critical. So this transition piece, and I'm sure Tracey will pick that up. The other one is I think we need green to become a rainbow. So we need to see blue bonds, we need to see orange bonds for gender, we need to see a number of different areas within the Sustainable Development Goals kind of really being able to open that up, whether it's in the bond or loan markets. And there was a specific question around the KPI, so this development of sustainably linked loans or sustainable linked bonds. And whether this is actually a good thing, because it's generating more capital to where it matters, or whether potentially it's actually open to some sort of criticism because it's not really driving real change. And I think it's all about the KPIs. Are you really driving change? I think that's what we all want to see. We all, I'm sure everyone on this call, wants to see the change happening. And so if you can set the KPIs appropriately, that it does incentivize that change and that there's a real impact to that if it doesn't, then I think that is actually very powerful as a tool for directing capital. And recently we did the first transition bond, which was actually a sukuk, so an Islamic format for Etihad. And in the KPIs there, if the KPIs aren't met, the company actually has to go and buy some offsets to make sure that effectively the impact is having. So I think there's some really interesting innovations in that. But Tracey, maybe coming back to you around just this broader issue around, is transition important to the bank as a whole? What are we doing about our own calculation of financed emissions? And how do we actually get this data in emerging markets in the first place?
Thanks. So transition, I think, is critically important. If we start from the proposition where I talked earlier, you look at our markets, they are markets that are at risk from climate change. They are markets which are in desperate need of driving their own development through cleaner forms of energy. But there are also markets which are in dire need of education, infrastructure, hospitals, and so on. And what we can't do, and what we don't think is the right thing to do, is for us to simply say we're going to cut off all of our support to anybody who is in what is classified as a dirty industry in the current world, and just say we're not going to finance that. We're going to finance windmills in Holland instead because we know that they sort of tick the ecology box. What we need to do if we're actually going to get to meet the SDGs as a globe is that we need to be able to help companies transition. And this links into the question of data, and it links into the question of how you measure emissions. It's an area where I'm pleased to say that actually there's a real coincidence of interest between what the regulators are requiring us to do and what we want to do in terms of driving our business and getting a better understanding of this. The Bank of England has sort of led the way on a lot of this in the UK in terms of stress testing to see what are the risks that the portfolio is exposed to as a result of climate change, both physical risks and transition risks. And that means we are actually going out to our clients, as will all of the UK banks be, to really get quite granular data about exactly what their emissions profile looks like and exactly what their transition risks are. We will use that as part of getting our baselines to really understand at a kind of much more granular level the emissions of different clients, and also use that as a basis for the start of a conversation about what's their transition plan. And we will expect at some point to require our clients to have transition plans. That's something we're working through at the moment, and our position statements that we publish and we're in the course of reviewing, we do that every 2 years, will include increased focus on this importance of transition. Some industries, that's quite well developed thinking in that industry. So actually oil and gas, for instance, has done a lot of thinking about transition. In other industries, it's much less well developed. So we will be building that data. We're working with other organizations to help us do that, and we're working with organizations like Imperial College and so on to actually build out then the technical measurement of those emissions. We have published some proxy data previously. We've published the progress on some experiments we've been doing in terms of emissions, but there'll be much more on that going forward. I think the other question that came up that you mentioned you wanted me to touch on, Daniel, was the social risks question. Again, we work on the ground in a number of these countries. We've had position statements where we cover things like the supply chain, labour standards, and standards in relation to other social issues, so displacement of communities and so on and so forth. We're a key voice in the Equator Principles group. In fact, I think we're chairing that at the moment. So we do for every transaction that we're doing in these markets, we have an environmental and social risk assessment that looks at those areas. We also publish every year alongside our annual report a sustainability report which gives some real examples, and a modern slavery report which gives some real examples of, for instance, where we've intervened, where we've had intelligence to suggest that there's child labour being used, and actually how we've worked with clients to tackle that. So there is very much strong due diligence in terms of projects we invest in, and we think that that's something that is, again, a positive of working through a bank like Standard Chartered into some of those markets.
Great. No, thanks, Tracey. I mean, maybe a question for all the panelists, which is a different one, which is, I think Lee Perkins just pointed out that greater impact in emerging markets, it also comes where probably the data is of the lowest quality. So how do we make sure that when we're deploying this capital to these regions, that effectively we've got the adequate protections around things like greenwashing and responding back to investors? And if I can, I'll try and contrast that with the question that at the moment has the most likes, which is from Paulson Thomas, where he's saying, look, you know, this is all great, but actually there are a number of areas where traditional financing, and he talks about project financing, but I think you could probably say the same about debt capital markets, can't attach because there isn't enough data that is required for banks. So on the one hand, there's obviously this big need where you may not have the adequate data. How do we solve for that? And at the same time, we need to give investors that kind of confidence. So I don't know if any of the panelists have a thought on either of those sort of issues, the tensions between them.
Shall I start, and then Henrik and Richard can jump in and correct me? I'm not sure there's necessarily a tension between them. I think we all recognise that the real challenge here is how do we get the data, the confidence to be able to really make sure that the money that's being directed is you know, being used for the projects that it's supposed to be being used for. Another question commented on corruption in some of these markets, which we recognise as a real issue. So how do we make sure the money is going where it said it's going to go? How do we make sure that the impact is then being measured and measured in a consistent way? I don't for a minute think we've got the sort of final answer on that. The impact report we've published starts to go to some of that. It starts to get quite granular about specific projects and specific investments that have been made and how those are translating in terms of measurement. And as I said previously, I think this is the question that really needs to be solved, because otherwise the flow of investment into green assets will go into green assets that might make people feel better, but actually won't make a big difference to what needs to be solved in terms of the markets where it needs to be solved. So I think, you know, we are doing a lot on this, and the Bank of England stress tests that I actually mentioned earlier, because of our footprint, the clients that we're actually going to be getting a lot more granular data about are all over the world, so we will have that. And you're also seeing other regulators joining forces on that. The Network for Greening the Financial Sector, I think, is now up to, you know, I can't remember, but it's many, many tens of regulators, including emerging markets regulators. So I think the flow is going in that direction, and data will improve. And until we get to a perfect data source, you know, we're doing quite a lot of on-the-ground work to come up with the data we need to verify that. But I don't know whether Henrik or Richard wants to comment on that further.
I think if you look at it from a financial markets type lens, you know, many times when new products start, there is not standardization, and it does take time. But as you attract more capital into a product, more standardization happens. So even in many of our emerging markets today, we do have, for example, domestic bond rating agencies who are also looking at ESG. We also have domestic firms doing verification. So I think there is actually very significant movement on it. But one of the challenges is that it's very wide space and does lack standardization today. Over time, that is going to clearly improve. I think that's also an opportunity for the early ESG investors to find those opportunities. Of course, that comes with risk. But I think overall the intentions are clearly good. We want to attract more capital. It is a very well-known and well-discussed topic. And I think there is meaningful progress being made on this, even if you look year over year, or if you look back 5 years, where we've come around Sustainalytics and so forth, there's actually very material change. So whilst an issue, I do not think that this is something that should hold us back or hold investors back.
Thank you. And I think we... Oh, sorry, go on, Richard.
Sorry, Daniel, can I just add to that? I think Henrik's entirely right, but I think the one thing that investors should always bear in mind is the level of transparency that we're seeking to provide. Yes, those challenges do exist, but I think the impact reporting and the transparency we are providing post-fact and pre-issuance with the verifications that we're getting, I think that's our attempt to be as clear and upfront as possible with the investor base.
Richard, I think that's a key point. I think that helps turn the question on its side, which is if you really believe in the importance of sustainable finance, and certainly we do, and if you really believe that frankly the world's trajectory, for example, on whether we hit Paris of substantially less than 2 degrees global warming is really going to depend on whether emerging markets get the necessary infrastructure to switch to low carbon business models and infrastructure, then we need to be directing this capital there, and hopefully working with a bank like Standard Chartered that's providing the transparency, that has the correct governance, is then a very powerful route to do that. And so I think that's almost putting it around on its head. And actually what's really interesting is if you look at the data around good ESG companies in EM, they tend to outperform. The IFC talks about 110 basis points outperformance, and it's no doubt because you're looking at a lot of data, and companies that are well run from an ESG perspective tend to then be quite well run on a whole number of other issues. So this is actually quite a good way, I think, of investing in emerging markets in the first place. And then just coming back to our bond, I think one of the powerful things about sustainability bond is it aggregates a number of different things. So for example, we have a very long-standing microfinance book, which maybe if you're a large investor or a private investor, you can't access directly, but through the bond, you get some sort of diversified impact into that kind of asset as well, that the bank is Standard Chartered is effectively running. We've got about 10 minutes left, so I mean, really loving the questions that are coming in. So please, if you've got anything else on your mind, do post it. I mean, Richard, maybe just coming back to you, what's the plans for future issuances? So we've done the sustainability bond. How is the bank thinking about this space from its own funding perspective going forward?
Yeah, absolutely. I think, as mentioned, I think we have a reasonable amount of funding to do on an annual basis. I think the really interesting thing is that as a bank, we don't need term funding in anything other than our regulatory capital space or MREL space. So it's natural for us to pair our regulatory funding needs with these kind of strategic projects and these kind of strategic initiatives. Given the scale of the green and sustainable assets that we have and that we're growing, I think there's definitely scope for more sustainable deposit issuance, and allied that to more overall bond issuance. I think the demand and the interest we received on the first issuance, which is now almost 18 months ago, believe it or not, I think that drives us forward into kind of our plans for next year. I'd be very surprised if, as we go through next year, we do not build on the success of the impact report and follow that up with more issuance. I think from the term funding strategy, again, that 5 to 7 year bucket is an appropriate tenor point for the investors. It's an appropriate demonstration of commitment to the sustainable funding on our side, and that works reasonably well. So having done the 8 non-call 7 in euros last time, as mentioned earlier, that euro investor base is probably still the most advanced and the most sophisticated in terms of the analysis they do and they bring to these sustainable assets. That makes more sense for us to target in euros again, looking into next year, and that's something that we quite like to bring to market sooner rather than later.
Great, thank you, Richard. Tracey, there's 2 hard questions here, so maybe I'll come to you to have a think about them. One on sort of effectively, are we going to see regulators actually starting to ask banks to hold capital against climate-related exposures? And then sort of the second question that's recently posted around, how is Standard Chartered thinking about this from a competitive advantage perspective? If other banks that are involved in emerging markets aren't running to these standards, does that put us at a disadvantage as an institution?
So I'll start with the second one, because actually I think we see this, and actually this conversation has illustrated this. We actually see this as a real competitive advantage for us, because we know that there is demand, whether that be demand from governments, whether that be demand from private investors, individuals, institutions, to actually invest in emerging markets, to invest in sustainability, to make that impact. And we also know that there is a degree of nervousness and sometimes a lack of confidence in to the earlier question, in whether that money is really getting to where it's said it's going to do and being, dealt with in the right way with the right sort of social and environmental protections. So actually, Standard Chartered, because of our ability to bridge that, because we do adopt, high standards, we're required to meet UK regulatory standards and so on, and we're operating in those markets on the ground, so we understand the circumstances there. We see that as a real advantage. Now, obviously, are there transactions that we won't do that local banks do because they don't have the same standards as us in terms of environmental and social risk? Yeah, of course there is, and that's been the case, for many, many years. This isn't a new issue. I think what is potentially the new and the actual upside of that is that people now are increasingly saying that this really matters in terms of getting capital there, whether that's capital from multilateral development banks or, as I said, whether that's capital from individuals. We're also seeing a lot of interest in these markets in building out the sustainable finance capability. So I think the year before last, or even last year, we were talking to the Indonesian regulators about what they might want to do in terms of their space around this. So this is, it started off maybe as more of a Western phenomena, but it's not limited to that. The emerging markets authorities are really interested in this question. On the Bank of England stress testing point and whether regulators will require people to hold capital, I think everybody expects that the part of the reason for doing the initial stress test is so that the regulators can get a view on actually what is the potential exposure. And the interesting thing about these stress tests is that they're looking over a 30-year horizon, which is not the normal stress testing horizon. I don't expect that the capital requirements will translate directly to this is a climate affected sector, therefore there will automatically be a capital held against that because of the sector. Again, this goes back to this transition theme we've been talking about. There are certain clients, and we know this already from the work we've done, there's certain clients that actually are in high emitting sectors but have a really clear transition path. There's certain clients that are in higher emitting sectors that maybe don't have that transition path. So I would hope that the regulators will be a bit more granular in terms of how they apply capital to the risk rather than just a sweeping climate related issue. We are also seeing in the recent EU changes the flip side of that, so some potential relief for greener assets. So there definitely will be capital impacts from this, and I think they will be quite evolving quite a lot over the course of the next couple of years.
I think maybe to add one point is also in terms of competitiveness. It's a competitive advantage in terms of attracting talent to the organization, because this is increasingly a really important field where our employees are championing not only individual projects within the bank, but also group projects and pushing the agenda quite hard. And I think when you look to employ, particularly younger generations coming out of university, ESG is a very, very strong theme. And if you're not strong in the ESG space, I think in future you're going to struggle to attract some of the top talent to your organization.
I think it's a really good point, Henrik. We're coming to the end of the session, and I have to say it's been a fantastic conversation. Thank you, everyone, for posting such good and challenging questions, and for the panelists for giving great answers. I'm going to come back to the panelists and maybe ask for a 30-second sort of wrap up or closing thoughts from everyone. But maybe just while I give them a minute to think about that, I mean, it's worth putting out, it's worth sort of saying that at the beginning of this year, we put out a report called Opportunity 2030, which looks at the Sustainable Development Goals across 15 of our markets and emerging markets, and actually did some bottom-up analysis and came out that there is a $10 trillion financing opportunity and investing opportunity for the private sector over the next 10 years supporting the SDGs. So I certainly think from our perspective, we see this as not only really important and something that banks are all going to have to take very, very seriously, but actually this is a competitive opportunity for investors and for Standard Chartered to really lean into as well. But maybe with that, Richard, any sort of closing thoughts from you?
Yeah, very briefly. So thank you for the support we've had for this panel, and obviously for our sustainable issuance and deposits in the past. Look forward to coming to the market. Look forward to continuing the dialogue with the investors. We've had some really interesting meetings this year. I imagine more interesting and more challenging meetings next year. And no, just keep the questions coming in. We're very open to receiving any and all questions that we get from investors. Even outside of transactions, we're very keen to kind of increase that dialogue.
Great, thank you. Henrik?
Thank you for everyone attending. Maybe to touch on 2 points. There was a quick question on project finance. That's a super important space in terms of renewables, solar, wind. We're very active there. We have a dedicated team, probably one of the fastest growing spaces and a great way to access ESG. On the back of that, you also see a fair deal of the ESG type derivative opportunities, which I think is going to develop. For us, 80% of the world's population is in Asia. A rise of temperature of 3% would obviously have a very material impact in the markets and the countries and where we live. So we're completely behind this. It's super exciting, and thank you for everyone's support.
Thank you. Tracey?
I'll probably finish where I started. So we've got 10 years to meet the SDGs for the reasons Henrik mentioned and reasons I alluded to earlier. It's never been more important. But the really exciting thing is there is huge appetite, huge demand. There are really challenging questions about data and the things we've talked about, but I really think that the momentum is behind this. We are really committed to playing our part. We think there's a huge opportunity, and we really would like to work with people to help us deliver this. We know we can't do it alone, but thank you all for joining in and keep the conversation going.
Thank you, Tracey. Look, I think on behalf of all of us, a very big thank you to our excellent panelists. And maybe just to close by picking up on Tracey's last comment, it's really all you out there that have been asking the questions and are thinking about the space that are really going to drive the change that we want to work with. Standard Chartered recently published a survey of investors that hold $50 trillion of asset under management. And despite the opportunities that we talked about, and despite the challenges and the need for that capital, what was really interesting is it said that the panelists, 88% of the respondents said that their emerging markets investments had outperformed, yet only 65% were invested in developed markets. And actually only 13% of that AUM was linked to the Sustainable Development Goals. So I think it's all about how do we catalyze this capital to move to where it really matters the most, that's going to determine the outlook for the next 10 years and whether we can get the world on track to hit the Paris Agreement on climate change and achieving the SDGs. So thank you very much, and we hope you have a great day. Talk soon. Bye-bye.